Moneyweb now. On the money.
This podcast is brought to you by Stanlib Asset Management. Invest in more certainty to navigate volatile market conditions. Chatting now with Luigi Marinus. He is Head Discretionary Fund Management at PPS Investments. Luigi, appreciate the early morning time. A recent piece you put out, you talk around we've been in a golden age of passive investing. A couple of years ago, passive overtook active mutual funds in the US. The data shows active struggling to beat the index. But you also point out that this really has been helped by that golden age. Low rates, practically no inflation, tons of liquidity in the market. And that's not always the case. As things shift, we might need to sort of rethink some of our thinking around passive versus active.
Good morning, Simon. Yes, that is 100% correct. And I mean, we can't ignore that passive has done particularly well over the last while, and it's been coupled with, of course, passive being relatively cheap compared to active managers as well. And I think the point that we want to make is just that things can change. And so having a combination of passive and active is generally the way that we would advocate for funds to be set up, or solutions in the DFM case. So just be careful, because the expensive stocks are becoming more expensive. And at times, eventually that does turn around. And so the idea is maybe not just to be fully in passive and have some diversified exposure across different asset classes as well.
I get you. I like that. And it is the case of, and I want to come back to what you just said there a moment ago, which is it's a blend of, and we'll park that for now. But in the immediate, yes. I mean, the challenge with passive is that concentration. It's gone up. We know about the tech AI concentration. We forget about the local concentration. 10 stocks, half of the index. And then, of course, valuations. We love those valuations on the way up. We made money from it. But now that gets risky. This is now the risk to that passive, because nothing goes up forever.
Exactly. And the thing that drives passive the most is momentum, of course. And momentum is almost defined by the most expensive and the largest stocks getting more expensive. And that works well under certain market conditions, like you just mentioned now, and has been the case over the last few years as well. What I want to say is more, if you think of a different way of thinking about it, in a way. If you think of, say, value investing versus growth investing, and people have been thinking about that for a long time. We know that value does well for a while, and eventually it turns around, and growth does well for a while, and eventually it turns around. So that's how we would think about it from an active and passive perspective. The difference, though, with value and growth is generally that active management costs are very similar. And now people are saying, well, the cheap part of the market is doing well, and so why do we even have to worry about the other side of the market? But at the end of the day, at some point, it's likely that we're going to see that turn around, and that kind of normal cyclical way that markets do work. And our point is more just be mindful of that and be careful that may happen at some point.
I absolutely got you. And passive is, and you made the point, you call it, it's a core B2 exposure, and absolutely, and that's what it does. But at times, and this is perhaps one of those times, we need to sort of shift that exposure. And I like your sort of value versus a growth analogy there, the active versus passive. It's not saying, let's move completely out of, but let's shift some of that focus to the active, because this is a different market to what we've seen over the last decade.
Yes, we do think so. And I mean, the question is out globally. Around AI, is it a bubble or not? And that's very difficult to predict, we know that. But what is likely is that there's going to be some winners and there's going to be some losers as well. And if you have an active manager that can maybe get some insight into what they believe to be the winners and which ones they believe to be the losers, they might end up with a better outcome than a passive investment that's going to be invested across the board, regardless of whether they think it's going to do well or not. And so there is that value, I think, in the active managers that can use some discretion, especially when things are quite expensive and you're forced to buy those expensive counters. And so kind of taken away a little bit from that could be quite helpful going forward.
Absolutely. And I'm thinking, because again, and we've touched on this, but I think it's bear repeating, is that in many senses, passive chases the hot new thing. And SpaceX, a recent example. And as an active investor, you might look at that valuation of SpaceX and think, whoa, don't know if I want it. As a passive investor, you were buying it regardless.
No, exactly. And that's by definition. And it has worked well
Sure.
for a number of years now, both locally and globally, probably even more so globally. But we have seen kind of, like you said, a lot of the hot counters are getting even hotter. And so, I mean, and that's coupled with a lower fee as well. And so you understand why investors are excited about it and saying this part of the market is definitely the way to go. But I think just some kind of rational thinking around it and seeing what the risks are for that, I think that's an important consideration.
Yeah, and the hotter parts of the market are just getting hotter, and I like that. And
Indeed.
that is the concern, that is the worry. We'll leave it there. That's Luigi Marinus. He is a head discretionary fund management, PPS investments. Appreciate the early morning. And that's our poll today on LinkedIn. Are you preferring perhaps more active over passive in the current environment? Are you shifting your weighting in that regard? Have your vote, have your say. LinkedIn. This podcast is brought to you by Stanlib Asset Management. Invest in more certainty to navigate volatile market conditions.